a lot of things we see on the market itself, on one hand, they're telling us one story, or there's a good for investor, but really good for investor. Personally, for me, I invest in the individual REIT and also invest in the REIT ETF due to certain reason. It's not fair you're holding this property when the whole market down, or you target together. Not like that.
How should they decide on the portfolio allocation for REITs?
At the present moment, actually, every sector is attractive. But there's one sector, right, need to be very careful. I think that sector will be the most attractive, but not suitable to anyone. You buy a property, you rent it out, collect rental, and you get a dividend.
Just like what you play in Monopoly. Struggling to keep up? Welcome to the FOMO Fix. If you're feeling overwhelmed with investment opportunities, you have come to the right place. On the FOMO Fix, we are here to help you build real wealth at your own pace, without the fear of missing out. I'm Hazelle from the Joyful Investors, your navigator on this journey towards financial empowerment. Today, joining me, I have two guests, Kenny and Thomas.
Thanks, Hazelle. I'm Kenny Law, Wealth Advisory Director from Singapore's largest independent financial advisory firm. I help clients to manage their REIT portfolio and also build their investment portfolio for their retirement. At the same time, I'm also the trainer from SGX Academy.
Hi, thanks Hazelle. My name is Thomas, and I'm a program manager working in the tech industry. So for me, I started investing mainly looking for investing for income, and that's how I got it myself to actually start investing.
Alright, so in this episode today, we're going to talk about a very interesting topic. And in fact, it's one that many investors have been discussing about widely in the last 1 to 2 years. And that's on REITs, Real Estate Investment Trust. Alright, so as we begin, let's get the definition out of the way first. So Kenny, could you share with us what exactly are REITs and how do they work?
Yeah, maybe just think of the REIT as the physical real estate investing. Right, because if you want to invest in the real estate by ourselves, we need to fork out a one lump sum. It's quite a big huge sum. It can be 1 million, 2 million in order to really generate that kind of rental income. But as a REIT itself, basically the REIT is putting the money from all the investors together. It's something like co-invest. They go and buy some of the real estate. It can be residential, can be hotel, can be commercial office, it can be industrial building, it can be the data center. Right. So after acquiring the real estate itself, they generate rental income. The rental income, after paying off all the miscellaneous tax and also the interest expense, the income will be distributed to the investor as a dividend. Basically, it's a co-investor scheme, and also it's a proxy for the real estate investment.
Right. For Thomas yourself, are you currently invested in Singapore REITs?
For me, I do invest in Singapore REITs. So how I look at REITs investment locally is basically I look at assets that I'm familiar with. So for example, I go to the malls and this could be owned by a REIT itself. So that's how I get actually familiarized with them, actually started investing and start looking at them.
Do S-REITs form a big part of your overall investment portfolio allocation?
I would say REITs-wise generally is quite a huge part because I mainly look at local REITs where I'm more familiar with and have more easier for me to actually look at it and do my due diligence, I would say.
Right. Regardless, no matter how big the allocation of S-REIT is in our investment portfolio, right, I believe that investors who have exposure to REITs in the last 2 years would definitely have felt the impact of that market decline that we are experiencing.
Right.
So
definitely.
Let's do a very quick recap of what has happened over the last 2 years. So we could actually date it back to the year 2022, where the US Federal Reserve started on the rate hikes so that they can curb the high inflation, which was caused by a combination of factors, right? We had the pent-up demand for COVID, and then we had supply chain constraints, and unfortunately, we also have geopolitical events, right, that has pushed up the commodity prices. So with higher interest rates, that will increase the financing costs for REITs, right? And there are many investors who become more risk-averse. They started to switch out of the REITs market, and then they went into other instruments, like, for example, the fixed income instruments that were paying a higher yield under this higher interest rate environment. So under this landscape, many investors right now, they are feeling very worried. So some investors, they want to stay at the sidelines, observe and wait first, whereas there are some others who will, in fact, completely stay away from the REITs market totally altogether. So Kenny, in your opinion, how can retail investors navigate the REITs market under this current landscape?
I think first thing first, retail investor need to refocus back to the objective again. Okay, for example, for this few years when the market is down, for me personally, actually I am acquiring REIT at stages. every month I have allocated certain amount to start to buy into the market itself, right? Because like what Warren Buffett said, when everybody is in fear, we should be greedy, right? So focus on the objective first. When we invest in REITs, the first objective in mind is the passive income. We are relying on the rental income from a property to really give us a dividend. That is the objective. Actually, the capital appreciation, capital gain or losses, those are already on paper, right? Actually, we should not pay too much attention for it. You just imagine that if you are buying the physical real estate, collecting a rental, what is more important? You are not looking at the property price every day, because the property price can go up, come down every day. The more important thing is we need to focus on whether we are able to get a rental, whether we can rent out our unit to the tenant, and also collecting a rental, and also rental actually increasing every year. So I think focusing on objectives is very important. Once we get the objective right, we are focusing on the passive income generation, then actually the market volatility is less of a concern. Especially we have a very long runway to really build up for our retirement portfolio. I spent close to 15 years to build up my REIT portfolio before I can reach my retirement sum, and also the passive income I want to generate from a portfolio. So along the way, you don't have one lump sum, maybe 1 or 2 million at one go, right, to build out the whole portfolio. You need, maybe you allocate 100,000 every year, right, for continuously 15 years to really accumulate 1.5 million, multiplied by 5%. More or less, we are able to achieve the kind of passive income per month that we want. So I would say that in summary, basically focus on objective, and investor, you'll have a peace of mind, and also very, very clear goal, what do you want to achieve when the market give you the entry opportunity.
All right. How about for Thomas? So personally for yourself, are there any actions that you have taken for you to be able to continue to stay the course in investing in S-REIT during such a period?
Yep. So I think for me, right, personally, I agree with what Kenny said. Actually, I think there's actually opportunity now for me, because I look at it. When times are good, maybe the valuation is not so attractive in terms of S-REIT, but now it's actually becoming more attractive. And for me, I'm able to do to research on it and look at it to see whether what's the income generated by the asset. And from there, I can look at the opportunity that I can actually size in. And what I consider now is maybe more, because of the environment, is actually to have a more conservative approach, where I look at maybe having that additional margin of safety, so that when maybe we will not know how the market trend will be, how the environment will last,
Definitely.
at least having that consideration will help me scale my investment into REITs and build up the portfolio itself.
Right. I believe that the current high inflation, current high interest rate environment, right, actually all those are part of a typical market cycle that we have to go through. Right? If history could serve as a useful guide, in the past, investors of many decades, they have experienced through periods of economic expansion, economic recession, right? We have also seen how the US Fed have raised rates, cut rates in many occasions in order to resolve the crises that were happening back then. So as long as there are changes in the economy, changes in the business profits, then the central bank will have to intervene appropriately. Yeah. So moving forward, once the inflation stabilizes, then the US Fed will start to normalize the rates once again, which they have also signaled their intention to do so, right? Although, yes, maybe moving forward, we may not be able to return to those very low level of interest rates that we enjoyed during the pandemic period. But nonetheless, then that would be the new environment that the REITs would have to navigate through. And then they have to change their game plan, adjust their strategy accordingly. Right, so earlier on, we briefly mentioned about interest rate sensitivity for REITs, but there are many investors who are still not very clear, how come high interest rates can impact REITs negatively. So Kenny, could you break it down and explain it in a more layman's manner? What is this relationship between the interest rates and REITs performance?
Okay, basically the interest rate impact on the REIT sector in three aspects. The first one would be the interest expense. When interest rate goes up, basically you as an investor, for example, if you're buying our property, we have to pay for higher mortgage loan. You just imagine that actually the interest rate basically they raised too fast and too steep. US Federal Reserve raised from 0.25% to 5.5% within 1.5 years. You just imagine it's something like today you are paying maybe $250 mortgage, then suddenly you have to pay $5,500 that kind of mortgage per month.
Yeah.
So it's too fast, too steep. Immediately the REIT manager, they are basically not prepared for it. because they used to live in a very low interest environment. Because just bear in mind that when you're investing in property, basically you are borrowing. You're having a leverage to really acquire a property at the same time to generate the kind of return. So when there is such a spike of the interest expense, immediately you have an impact on your DPU, because you have to pay off all your interest expenses first before you can get a net rental income.
Right.
Then immediately you have a decrease in the DPU performance. Immediately you have a hit in the share price. That's one aspect. The other aspect is you'll be high interest rate. You'll be impacting on the portfolio valuation, because cap rate is highly correlated to interest rate hike.
Right.
Cap rate also has an inverse relationship with a portfolio valuation. When interest rate goes up, your portfolio valuation comes down. Means that your property value coming down. For the investor out there who traded REIT in the secondary market, basically they will start to sell off the REIT and move to some other asset class, because they always traded as a ratio. One of the ratio investors should look at is a price to NAV or price to book. NAV stands for net asset value. So there's always a ratio. When the portfolio valuation comes down, your share price has to come down accordingly. All right? Those are just a pure formula. And the third aspect is nothing to do with the operating performance. Basically, it's the yield spread. When the interest rate goes up, the 10 years US government bond, which is a risk-free rate, goes up. So the fund manager or big institution, they always use this yield spread as a guidance to switch their asset allocation. So for the past 1 or 2 years, the yield spread has a very strong inverse correlationship. It becomes very technical now. Inverse correlationship to the Singapore REIT yield. So when the yield spread goes up, basically there's a compression. When a compression happens, dividend yield compression happens, the share price has to come down to really maintain the kind of yield spread. Very, very technical. So in short, the impact would be the first dividend you'll be impacted because higher interest expense. The second thing is the portfolio valuation comes down. The share price has to come down to maintain the kind of ratio. The third one is the yield spread compression. That's why the share price also has to come down. But if you look at on the impact itself, there is also the opportunity when interest rates start to come down, because everything will be reversed. So I would predict that when the interest rate start to reduce, or we have a better clarity on the interest rate direction, I think the REIT sector itself, you start to go back to the bullish mode. Because at the present moment, if you look at the FTSE ST REIT index itself, they are forming a base now, close to the previous low.
Yes.
It's quite close to the previous COVID low already, March 2020. Right. And currently, it's just moving sideways. I'm just moving for the technical indicator to show the turning to the uptrend.
Reversal into the uptrend, right? So right now, a burning question on many investors, maybe on Thomas as well, is when can we anticipate a market turnaround for REITs market and for its outperformance again? What are your views on this?
You want to start first?
So for me, I think I wouldn't would say I have very good insights into how the interest rate will go. But I think what I do is I make provision for it. I prepare for it. So whether the interest rate come down or go up, at least I wouldn't take on too much risk. I also actually kept my risk in terms of how I look at it in my investment decision. So if I able to actually the rate do drop, I can capitalize in terms of the upside because I start scaling it in. But at the same time, I don't go too far in or build up too much position if the trend actually goes sideways for a longer period of time. That's how I look at it.
So gradually.
Gradually in the sense. Yeah.
How about
Actually, I agree to that, because now we are all anticipating interest rates start to drop.
Yeah.
But we also need to plan for another scenario. The interest rate, you stay longer and also start to hike again. Okay. By the way, if the interest rate start to hike again, I think the REIT price will continue to come down again.
more drawdowns?
Yeah, more drawdown. So I would suggest that the investor to enter in phases. Currently, the whole REIT sector is trading 20% discount to the book value. It's pretty cheap. So at the present moment, some of the REIT, they are still able to give us a very good dividend, right? And quite consistent. Some of them is quite consistent. Some of them only have a little bit drop in the dividend.
Slight dip.
Slight dip only. But I think that when interest rates start to be normalized, the dividend will come back. But they are offering 20% discount at the present moment. So if you look at the total return, all right, when the whole REIT sector back to the normal, probably you have a 20% upside, minimum 20 to 30% upside, purely based on valuation itself. At the same time, the REIT sector as a whole now is based on market cap, the dividend yield, you're giving us around 6.5%. Right? So that means close to 30% upside potential if everything back to normal. But investors really need to wait, need to be patient, wait for the interest rate start to drop. And don't be surprised that actually the REIT sector will start to move ahead before the interest rate start to drop, because the market, they're always in anticipate, is forward looking, in anticipating interest rate start to drop and the REITs will start to move. So what I'm focusing now is basically I'm look at the chart itself to look for some indication when the big institution money will be coming in. Right? Because retail investor, we can't move the market. Our bullet is just too small.
Yes.
But a big institution, we can see clearly that when there's a trading volume increase and when there's a breakout from the current consolidation pattern, maybe that's the first step, that first indicator we should look at.
Right. I mean, I can truly understand where many retail investors are coming from. Perhaps during such market downturns, they are feeling that kind of frustration and anxiety, right? But unfortunately, when the market will turn around, it's often beyond an investor's control. Neither is it something that's easily predictable. So rather than to be fixated on things like this, I would rather focus my attention on things that are within my control, like some of which you guys have already mentioned. What REIT are you buying? Are you buying a resilient REIT in the market? Then what price are you buying at? Are you buying at a reasonably good price where the risk to reward is more in your favor? So these are the actions whereby if I commit to these actions, it will help to increase the chances of us profiting from these investments that we're undertaking right now at this moment. So rather than to ask about when would the market turn around, perhaps a more important question is, when it turns around, can we profit through the investments that we are undertaking at this moment? Right. So for those investors who are keen to consider REIT investments, what are some factors that they can look out for so that I can see, whether this is a good REIT investment versus one that is perhaps less ideal? So for Thomas, personally for yourself, what are some factors that you look at before you jump into that investment?
Yep. So for me, one of the asset or REITs that I look at maybe is retail. So for retail REITs, it's generally easier for me to actually analyze. So for example, what are the malls that I tend to go more frequently? So I go there, I can see the traffic footfall.
Yes.
I can see how the tenants are doing, the shops, retailers
Traffic
there.
flow.
Yeah, traffic flow. Are the shops there always filled up very quickly? I think that's one good indicator that I look at. So this helped me to form the idea whether how is the REIT performing. And because end of the day, when it's all fully tenanted up, that's where the rental income will come in. So that's how I look at it in terms of my REIT investment.
Right. How about Kenny?
I totally agree to that, because during COVID time, actually everything is so cheap, right? Okay, in terms of valuation, I also need to overcome my fear when entered during the market low. March 2020, I still can remember, it's a market low. So actually, I did visit some of the malls to really feel it before I can enter. It is quite scary because everything is being shutting down, right? But once I look at the mall, we still have to visit the mall, visit the grocery shop to really do shopping.
For your
Then
necessities.
then give me more confidence to really enter at the market low. So physical visit of the portfolio itself is very, very important. If for the beginner, if they don't really understand what they are investing, because when it comes to investing, the investor need to really understand what they are investing. I think that's a very, very important thing.
Yes.
But if you look at the financial perspective side, I would suggest the investor look at three key things, right? Just make it very, very simple. The REIT must have a very good track record in increasing in dividend. I think that's very, very
Definitely,
important.
yes.
Right? That's a trend. Trend is very, very important. But of course, during the COVID time, some of the dividend, actually there's a dip. Right, but those are the tentative or temporary dip.
Yeah, which is understandable.
Understandable.
Yeah.
So the trend is important. That's first thing. The second thing is refocus back on real estate investment. We want our portfolio value continue to grow, right, year over year, and also we need to look at a net asset value trend. If a trend is going up, right, in the long term, that is also a good sign, right? Vice versa. If you are seeing some of the REIT that DBO trend is coming down, NAV trend is coming down, those are the negative sign. Those are the warning sign already. So these two are the very important factor. The third one, at the current high interest environment, gearing ratio is very important, right? We try to avoid those REIT with very high gearing ratio, especially more than 40 or 45%, because if they are not able to pay off all the mortgage or the interest expense, they will have a big problem because they have to sell off the property. Once they sell off the property, immediately they have a impact on their DPO, at the same time impact on the net asset value.
Right. So both of you have raised really important and essential factors that we should assess before we jump right into investing in a REIT. So perhaps to add on another area that you can look at also, it can be the net property income. So take a look at what is the profitability, what's the trend, right? Whether it has been growing over the years. So these are just some of the different areas, be it operational performance or financial performance of the REITs that investors can look at.
Yeah, investor, if you really want to analyze the REIT in depth, there are a lot more things to look at.
Yes.
So these are the really three basic things
Yeah, this
to
is just
start off. Yeah.
for us to actually begin off, right,
Yeah.
on this. For myself, I actually have a interesting red flag, which it might come as a surprise to many people. So for me, if I see a REIT that has excessively high dividend yield, usually I'll be very cautious about the investment.
Actually, that's caused by the share price.
Yes, right. Because on the surface, it may seem that the higher the dividend yield, the better, right? I'm getting more as an dividend investor from this investment. But we have to look at how dividend yield is computed, right?
Yeah.
We take the DPU, distribution per unit, divided by the unit price. So if let's say under a scenario where the REIT is giving us the same amount of DPU, but the dividend yield is boosted because of the declining share price, then are there any issues with the REIT itself? Sometimes if you see that the share price has been on a downtrend for a very extended period of time, perhaps that could even point to some fundamental issues with the REIT itself. Then if the REIT has some fundamental issues, maybe that might impact their ability to distribute stable dividends in the future. So it doesn't mean the higher the dividend yield, the better. So for me, this is like some kind of red flag if it's excessively high. So a little bit more on the contrarian side.
I agree. When I first started off, I always look for a REIT with very high dividend.
Yeah.
That's where I get caught and lose money.
Yeah,
Right? But
right.
over the years, I become more and more conservative. Now I'm pretty happy with 5 to 6 dividend yield. Right? It's pretty safe when you invest in a REIT, give you around 5 to 6%. But if you invest in a REIT, give you 8, 9, 10% or 20%, the kind of range.
Analyze further.
You have to analyze why.
REITs.
Why? There must be a reason, because there are someone even smarter than us out there know what is going on. Because a lot of information, the big institution investor, they may know more than us, all right?
Okay.
So they sell off first, they get out first. And for us, a retail investor, we just based on the information on the internet, based on the earnings report, and make the investment decision. And do take note that whatever information out there, they are all lagging data or lag. But the big institution, fund manager, they have a lot more information than us. They know what is going forward. They know what is the future forecast on the cash flow. They know what is the commercial office, maybe sector, the valuation going on. They know a lot more thing on the ground what's going on compared to us. So do take note that whatever data we analyze on the internet, on the screener, they're all lagging. That is one of the big pitfall that actually investors should avoid.
Right. So for beginner investors who are looking to invest in Singapore REITs, what are your views on this? Because with this current sell-off, right, do you think that REITs still remain as a suitable asset class for beginner investors to consider for their portfolio? Kenny?
I think that REIT is still very suitable for all sort of investors, especially for beginners, because REIT is easier to understand in terms of business model, right?
Okay.
Compared to tech stock, compared to crypto, it's much more easier to understand. Basically, it's a landlord business. You buy a property, you rent it out, collect rental, and you get a dividend.
Just like what you pay in Monopoly.
So it's quite easy to understand, and also quite easy to verify if you stay with those malls in Singapore, because you can really go and verify. Because whatever the management say about this REIT, you can go to the portfolio and verify whether the occupancy rate is there, whether they are able to generate a higher rental income. You look at the foot floor, you look at traffic, you look at whether you are able to get a car park, right? Roughly you know whether how
Can
good
tell.
is the performance already. I think it's still relevant compared to other asset class. For example, if you invest in some other stocks, right? Maybe telco company. First thing first, you need to understand what the telco trying to do, right? And if we invest in some of the maybe commodity company, right? Then you also need to understand which sector they are in, what kind of commodity they are trading, and you also need to monitor the commodity prices. So a much more complex if you invest in other stocks compared to REIT. So that's why at the end of the day, I trade commodities, I trade CFD, I trade option before for many years. Too many things to watch. Then after that, when I'm planning for retirement, I stick to REITs because
Alright.
it's easy to understand, and also as long as you are having the good REIT with a good portfolio, basically you just have a peace of mind. Another thing is the peace of mind.
Can sleep well at night.
Can sleep well at night. The sleep well factor is very, very important because a good portfolio and well diversified portfolio with a good risk management inside a portfolio can really make you sleep pretty well. If you're investing in something that you don't feel comfortable, you can't sleep well, that is not a portfolio for you.
Right. How about for Thomas? If let's say you have friends who are starting out in investing, would you want to share more about REITs with them?
Yeah, definitely. I think for REITs, right, because it's like what Kenny mentioned, it's actually very easy to understand because all these are physical asset. So when we look at physical asset, we know how the income are being generated. And end of the day, if we look at maybe say the REITs itself, this building itself, how much is it worth? What's the valuation? And how can it be, let's say, if the income are not there, for example, due to certain cyclical trend, does it have that valuation retained? And this will give us a peace of mind, like what Kenny mentioned, whether moving forward, do we think that, what's the NAV, what's the price to book ratio in terms of the REIT? So does it hold up in that sense? So I think for beginner investor, this is something that is good for us to actually start understanding and actually to pick it up to actually generate income through investing.
Right. Likewise, for myself, I also believe that definitely REITs will still remain a suitable asset class for beginners. And there are a couple of reasons why this is so. So firstly, if you take a look at some of the resilient REITs that are listed on SGX, some of them they are really able to provide decent yields that can beat inflation over the long term, assuming on average about 2 to 3% over the long term for inflation. Yeah. At the end of the day, most of us, right, one of our top priority as to why we invest is because we want to beat inflation, right? We don't want the value of our money to erode with time and with inflation. Then secondly, the dividends that we receive for the REITs that are listed on SGX, they are not taxable in the hands of the investor. So that's very cost effective for us. Right. Furthermore, here in Singapore, there are actually a lot of opportunities for investors to learn more about these REITs that we have in the Singapore market, right? Through all the webinars, through all the programs that are organized by SGX, by other organizations like REITs, SIAS, and so on. So in fact, investors can even hear directly from the CEO of the REIT managers, or even have your questions being answered by them. So that's a very good learning environment that has already been set up by the relevant organizations and bodies. So at the end of the day, it's very important to remember that any investment, it involves risks, right? All investment involves risks, all investment involves volatilities. So rather than to try and avoid those volatilities altogether, perhaps we should try and learn how to manage the impact of volatilities on our portfolio, right? And in fact, that's also why I usually share with my my students that if you experience a market downturn early in your investing journey, that's actually very valuable experience because at the start, usually you are dealing with a smaller pool of funds. So the damage, right, the impact if you make any mistakes is usually more contained, right? But these are the valuable learning lessons that you can apply over the long term, and that is what will shape you into a more resilient investor in your investing journey.
Actually, 100% agree. It's better to lose money earlier.
Yeah.
So that you can become more defensive.
Yeah,
because
rather
you
than
really need to pay the school fee to the market. You cannot run away.
Right, rather than you make that same mistake when you are handling a much bigger portfolio. Right. Another question on many investors' mind is how should they decide on the portfolio allocation for REITs, given that maybe there are also other opportunities in maybe, let's say, other equities in the Singapore market or even beyond the Singapore market. So how can they go about making such a decision? What are some of the considerations, Kenny?
It really depends on the investor life stages. That's one thing, and also the risk profile.
Right.
And also whether they are, how comfortable are they with the certain asset classes, right? So for me, I'm quite, I know REIT quite well. So I have a big position in the REIT portfolio itself to rely on the passive income. But not necessarily this, my allocation is really suitable to anyone. So when I manage my client or advise my client an investment portfolio, the rule of thumb recommendation is never exceed 30% into a single asset class or single sector. So REIT is considered real estate sector. So if they really want to have a very diversified portfolio, then maybe not more than 30% as a rule of thumb. No right or wrong. It depends on their comfort level, right? Then if you want to look at some single stocks can never be more than 10% per single stock. Because I also understand some of the REIT investors itself, they do not want to have such a big portfolio because they do not want to have 20 REITs to monitor. They really focus on 5 REIT, right? But actually that strategy is pretty risky. Because if you are allocating your total return portfolio to only 5 REIT itself, that means each of the allocation is 20%. If something goes wrong with the REIT fundamental,
Then
right,
20%
basically
is
20% will wipe out.
okay.
So I think that managing the risk of the portfolio is much more important when we are enter into our retirement age.
Then how about REIT ETFs versus individual REITs? What are some considerations that investors can have so that they can decide whether I should go for REIT ETFs or should I go for individual REITs? Like, for example, Thomas, for yourself, do you find REIT ETFs useful for you in this investing journey?
To be honest, for me, I don't really venture into REIT ETF because I think it's kind of maybe getting too diversified. It's a bit hard for me to understand or what's going into that ETF. It requires me to do additional due diligence to actually understand more. So I focus on individual REITs itself, where maybe I can understand the sponsor better, and that's how I actually get into my investing in REITs.
How about
Actually, each of them got pro and cons.
Yes.
So the pro of the REIT ETF itself, especially for a beginner, you do not need to do homework, right? Basically, you just invest in REIT ETF, then doing the money regular saving plan or investment plan, you can invest into the REIT sector consistently, right?
Okay.
It's a lazy way of investing, right? But on the other hand, it's basically you do not have choice to really choose. You are investing in a basket of REIT, be it overvalue, undervalue, good REIT, bad REIT, everything you are just bao ka liao.
Yeah.
Right? So that's one disadvantage. You cannot really customize to your needs. But personally, for me, I invest in the individual REIT and also invest in the REIT ETF due to certain reason. For cash, I am investing in individual REIT. I built a portfolio of around 20 to 25 REIT, so we're very diversified. But when you are using your SRS money and CPF OM money, then it's better to use a REIT ETF. It's a corporate action because as and when the REIT has to raise fund by issuing right or having some private placement, that require investors to some time to subscribe to new rights. When you use up your money in your CPF OA and use up your money in SRS, you are not able to subscribe, right? Because there is a maximum limit. So that will end up with a share dilution. So that's a disadvantage. So that's a reason that I seldom use my SRS and also CPF OA to invest in individual REIT. If you want to do that, you need to make sure that we have sufficient fund just in case they need to issue the rights, right? But by the way, for education purpose, REITs has to distribute more than 90% of their net property income, right, in order to enjoy the tax transparency. So the REIT itself, basically, they don't have enough cash for new acquisition or do some other things, right? So whenever the REIT manager need the money, they have to raise some from investors like us. So do pay attention if you are a beginner, you need to deal with all the corporate action.
Any instrument, they have their pros and cons. So it depends on which one is more suitable for you. Like what you have mentioned, if you don't have the knowledge at this moment, then maybe ETF can be a good one for you to dip your toes into investing in the REITs market, right? But if let's say you would like to beat the market, you want to outperform, right, capture the alpha, then perhaps you would like to look at individual REITs and pick the more resilient ones, right? I may sound like a broken record, but there's this one analogy that I always use to share, and that is, you can see it as like traveling. So traveling, you also have people who wants to plan their own itinerary, right? Then you also have people who they want convenience. So I don't want to do all the planning myself. So I will just go with those tour agency for the planned tour. Yeah, but there's nothing wrong with both of the options, right? It's just that there are additional considerations that you have to take into account when you are choosing either one of these options, right? Moving forward, are there any specific sector within REITs that you believe may outperform in the next couple of years, or you think they deserve a closer attention? Any one of this, Kenny?
At the present moment, actually, every sector is attractive. But there's one sector, all right, need to be very, very careful, which is U.S. commercial office, all right?
Right.
Because if you look at the reward risk return ratio, it's pretty attractive, right? Besides, we don't talk about dividend because now they are suspended the dividend,
Yes.
right? But if you look at the price to book itself, it's only 0.2, which means that if your portfolio value is 1 million, at the present moment, the valuation of this portfolio is only 200,000, right? It's too cheap to award. And if you look at the portfolio itself, there are the trophy building, there are some of the very grade A office in the CBD area. You just imagine in the CBD area, will the building just disappear one day? It will not, because in the real estate, everything is cyclical. Eventually, they will come back. The building is still there, right? But of course, a lot of people discussing, worry about the work from home, that kind of trend. But personally, I think that over the long term, eventually, we will still back to office. For example, in Singapore, everybody back to office already because human is still a social animal, right? We cannot work in a home forever. You still need to have some interaction. So those trends are really temporary. At the present moment, it looks like the U.S. commercial sector is really bottoming. At the same time, actually, the trend of coming back to the office is recovering. Now just waiting for the interest rate. So if you really look at the return risk ratio itself, I think that sector will be the most attractive, but not suitable to anyone, because that is different ball game. It's not a dividend, not a dividend play, but it's a capital gain play.
On the recovery.
In the recovery.
Yeah. So as we are drawing towards a close for this episode, right? Thomas, do you have any burning questions that you would like then to be answered by Kenny on this topic of REITs?
Sure. I think Kenny touched a little bit about rights issue. So I just have one question, right? On how do you make the decision or evaluate rights issue, whether is it yield accretive based on what's the REIT sponsor they are actually acquiring in terms of the asset?
Actually, it's quite difficult to evaluate. You just depends on whether you trust or don't trust what the REIT managers say when they have a right issue, because they always have an objective when they're doing something right issue, right? They either go for acquire this property and maybe at a certain discount, and they give you some yield accretive, that means better than the current yield. Those are their story, right? Whether they are able to really achieve that after the acquisition is another story. So I think that at the end of the day, focus on objective and also focus on the track record for the manager. If based on the track record, every time they deliver what they say, what they commit, then you know that they can be trusted. But some of the REIT manager, they keep missing. They tell one thing, then they deliver another thing. But as a rule of thumb, most of the time investors have to subscribe to it, because otherwise we have a share dilution.
So it's very important for us to look at their report card, whether how are they performing.
The track record.
Yeah. Sometimes the REIT, they're going too aggressive in terms of acquisition. It may not be the good thing also, because investor might not want it, because on one hand that you're receiving dividend, on the other hand they're asking you for money, right? But some of REIT they never issue right for any new acquisition, but you don't see the dividend grow also. So it really depends on which REIT and which REIT, which sector you are preferring.
So increasingly, I do see trends of REITs actually acquiring overseas assets. So they are trying to actually have more diversified portfolio. So how do we look at them holistically in terms of investment?
Two reasons. The first reason is whatever good property in Singapore to be REITed, you can't find any. Right? If you can find any, that means they are not really yield accretive. Right? That's one reason. That's why they force a REIT to really go overseas to look for yield accretive acquisition. Okay, that's one thing. Second thing is more related to the industrial sector itself. Because the industrial sector or industrial building in Singapore itself, they have a very short lease term. I think the latest one, 25 years, 30 years, they're very short lease term. You know that when the land lease getting shorter and shorter, your asset value will start to drop. So in order to solve their declining NAV, they have to acquire or rebalance a portfolio to more freehold industrial property. But in Singapore, you don't have any freehold in industrial property. So the only way is to go overseas. You go to Japan, you go to Australia. You still have a lot of freehold that count industrial property. So this is the one area we have to pay attention to. And you can see that some of the REIT manager itself, they have already indicated clearly that how they are going to solve all this kind of declining trend. They are start to expanding to overseas. So it is a mega trend they cannot avoid. If they continue to stay with Singapore with a shorter and shorter lease term, they'll get into trouble.
So now, where do you see that segment, for example, now industrial REITs? How do we look at them in general? Do you think that they are actually acquiring assets? Because when they go for acquiring of assets, they usually don't acquire just a single building. They might acquire multiple buildings. So how do we look at it in that investment point of view, whether the assets are good in that sense that it will help us to actually build a more resilient portfolio?
I think at the present moment, beside the valuation of the REIT itself is down, right? But if you look at on another aspect, actually there are also a lot of opportunity in the market itself. Because the valuation is down, right? That means that in the market itself, there are a lot of REIT, good REIT with good portfolio and also good usage one. They are also selling at cheap. So it's a good time for the REIT manager to go for acquisition. That's why I think that the next phase, the M&A will be coming back again. They'll issue a lot of rights again, right? So whether they want to really redefine the usage, for example, when we go for acquisition, portfolio with low occupancy is a good acquisition or bad acquisition? Your
Low
will.
occupancy.
Right.
On a general point of view, if the current low occupancy, definitely it might not be something that is ideal for the REITs, right? But I mean, after acquisition, how the REIT manages it, I think that would be what is more important going forward.
Actually, it's very tricky, For majority of investor, when the looking at when the REIT going to acquire the portfolio with a low occupancy, they have a very negative perception. They always want to look for a portfolio or already have a very high occupancy because you have a really stable that can render income coming in.
Yeah,
but on
definitely.
another hand, if you want to boost out your NAV,
Okay.
you buy the portfolio with low occupancy, your valuation is low, right? If you are really can do the AEI, you
To
leverage
enhance it.
to enhance it, to really build more floor space, and also leverage on your current tenant base to really fill out the occupancy. Once your occupancy up, once you're done your AEI, your valuation will goes up. That you boost your NAV and boost your DPU, right?
Yeah.
So this is one of the game for some of the REIT managers that are playing. They allocate certain fund. They are just really look for those lock-up property. They do the redevelopment. This is how they enhance the value.
So in the first phase, the REIT must have that capability. They must have that good record as well of being able to execute such a enhancement.
Correct.
Yeah.
That's why you look at okay, this one cut later. If you look at one of the logistic REIT, basically you can see that every year they buy and sell, right? They invest and divest, right? And also when they invest, they are looking for all those property which is undervalued, which have a real development potential. They after develop it, they after rent, have a good tenant base, and after sell it. Then milk it. Because for example, if you want to invest in a Singapore property itself, right? I'm not sure your strategy because when I invest in Singapore property itself, I really look for those rundown property and nobody want to rent it out.
Okay.
And renovate it, get a tenant in, because immediately once you lock in your lease, you can sell at a higher valuation.
I see. So on that note, right? So if let's say when we, as a retail investor, how do you look at the sponsor itself? How do we know whether are they reputable? How strong are they? Yeah, do they able to actually acquire better assets or actually pass down the asset into the REIT that are actually of good quality?
There are two types of sponsor. So one of them is a developer sponsor. Developer sponsor always have interest in line with the REIT itself, right? Because for the REIT itself, they can leverage on the developer network and also experience and specialty, and also help them to enhance the portfolio. Maybe they have a first right of refusal to get some portfolio, their current portfolio into the REIT itself. so that developer sponsor. Okay, I always look at developer sponsor is a stronger sponsor. The other sponsor will be the financial sponsor. Financial sponsor, everything is money and cents, dollar and cents, right? They go in, they do some restructuring, then after that, they just want to catch up. They always make money. It's not long-term per se. So when you see some of the saga in the current REIT sector itself, okay, you know the saga, right? Okay, we have some want to change from the external manager to internal manager, that kind of saga. Those are financial sponsor. Okay, they are not going in to really help the growth of our thing. Basically, they just want to optimize it and sell it. If you look at that so-called sponsor, the strategy, basically it's an activist, that kind of activity. It's not for long term. Because for the developer sponsor, why they always have the best interest in the REIT itself, because they provide the external management service. That can be the recurring income for them. When they can generate recurring income from managing the REIT, they'll pump in the best property into the REIT itself, so they can continue to generate the recurring income. They are not going to pump in all the lousy property into the portfolio. Correct? It doesn't make sense, right? If you pump in a lousy portfolio, how going to continue to manage it, right?
Yeah, makes sense.
So a lot of things we see on the market itself, on one hand, they're telling us one story, or that's a good for investor. But if you think totally really good for investor, it's really not good for investor. Because as a REIT investor, when we go in, the objective is consistent dividend over the long term. That's our objective.
Okay.
We are not going in for the quick capital gain. After that, we cash out. Because if you want to have a quick capital gain, I must well play crypto. Right? You have some other asset class or gold, that kind of have a capital gain. Right. So need to differentiate the developer sponsor and also financial sponsor.
Okay. Usually, for me, interestingly, for me, I start off having REITs that are more maybe retail side. But over the years, right, they actually sort of consolidate and become including some of the commercial buildings. And then now my REIT portfolio become more diversified. How do you see it? Is it something that is good for investors, or?
It's good for investors. It's more important to diversify, because you can see that actually over the years, you can see that there's cyclical nature within the REIT sector itself. Industrial actually down before COVID. Then after the e-commerce come out, right, they say that all the retail mall in Singapore will be gone. Right, even Bloomberg come out article, all retail mall, they just go to the Orchard. That's why don't be manipulated by all this kind of news. They just go to one strata title empty mall, take a picture, then after that conclude, the retail sector is gone, right? So what's happening to the retail mall now? It's one of the most defensive and also resilient, because they can reposition themselves, now become a big mega food court and also tuition center for our retail mall, right? So this is what's happening now. So after the retail mall thing, then during the COVID, the hospitality sector did not beaten, right? After the hospitality sector, then 1 year there is a big boom and rally on the data center. Then in 2022 and 2023, data center the worst performance. Okay. Then after that, what happened? Commercial office. Right. That's why you can see that actually there are some mini sector rotation in the whole REIT sector itself. You can't control. If you really want to play all this kind of thing, that means eventually you in the REIT sector itself, you go in and out, go in and out. Then you defeat the purpose. So when you have a diversified portfolio of every sector, okay, you rotate. It does not matter to me anymore. That's how I play. Because after a while, I also give up. I'll also give up all this kind of sector rotation, mini sector rotation.
So it's actually quite cyclical in the entire REIT sector. Yeah.
The next one, I don't know, right? I think that the commercial office will recover eventually, right? The next one, which sector will be hit? I don't know. Maybe industrial will be hit. Because now there's another news coming up, talk about Changi Business Park, right? Then they are also talk about the international business park. Then the business park will be hit. That's the reason why Ascender's REIT now also hitting very badly.
So you don't just only focus on the retail REITs, but you try and put in the other subsectors of the REIT as well, so that it can be a more resilient portfolio overall.
Yeah, and also we also need to understand that Ascender's Maple Tree, they are government backed. eventually they're Temasek there. They are really influencing the plan out the Singapore economy. They will not let the whole thing die, the business park die. They will not. They will do something and change of use or whatever thing. Actually, I was on Money FM. Michelle asked me on the Changi Business Park. Right? Actually, I mentioned that just change of use. Because the strategy has changed. When they started the Changi Business Park, original is a back office to all the financial service at the back office. But you see, actually distance is very far, right? Not convenient. But what is the advantage of Changi Business Park? They are very near to the airport. And all our airport will be consolidated in the Changi, right? So can we just redefine a use? You don't use it as a back office or IT support of the financial sector. Can we become an aviation hub? You already have one Seletar. Can you make it as a Changi Business Park aviation hub, right? And also make it as a logistic center. Just change of use. JDC had to get involved, and also the URA had to get involved, right? Just do the master plan, replan, rezone. Then you revive already. And the REIT manager, Ascenders, they have been so big, they have been so many years experience, they know how to revive a portfolio. If they are not able to revive, they also can influence the government, right? If they are not able to influence the government, that means they just sell the property and get a proceed to go and buy some other thing. The REIT manager, they are flexible. It's not say you're holding this property when the whole market down, or you die together. Not like that.
When you say there's opportunity, the sector is down, usually I will look at it where it's price to book, the NAV, whether it's attractive enough. So usually I will see what's the price currently, and then these are a few factors that I look at. For you personally, how do you actually look at it when you think that, when it dropped down, where it's attractive enough for you to start going in to actually look at investment?
Okay, I look at because when you look at the pure number itself, price to book, it just gives you some indication what's the percentage, right? But some of the REIT itself, they're always traded at a premium. For example, the healthcare REIT, one of the premier healthcare REIT, they're always traded at a premium. One of the also the Temasek Link REIT, they always trade at a premium. They can never trade below the book value. So it's important to really look at the 5-year history or 10-year history, the trend. Then you look at whether they are trading at the average level, -1 standard deviation, -2 standard deviation. That gives you some rough guide. It's something like you doing the valuation of the stock itself. You use PE ratio. You look at what is a historical low, what is a historical high, then have a gauge on it, and all these things are lagging data.
Yeah, I think that's very helpful. I think it helps us to actually know what's the entry point, and then when should we actually have that range to go in, and scale in the position progressively.
Right, and you look at the chart itself, price to book. Once you touch the -2 standard deviation, very frequently they'll start to rebound because the mean reversal.
Yeah.
Right. Then if a past pattern, they always show this trend, more or less you don't need to time already. Just look at price to book. Then maybe you want to add in the chart. Then let the chart to tell you when to go in. You know that valuation more or less there already. Now let the chart to tell you the story when to go in.
Yeah, I think that's maybe something like safety margin where we can look at it. Where you go down to the support line, that's where we can look at it and then scale in.
Yeah.
So as we wrap this up, Kenny, what final advice or thoughts would you like to share with beginner investors who are looking to invest in REITs?
Okay, first thing first is always invest what we can understand, and that's the most important thing. And also start early, because it's very, very important. Start early, and also start to, instead of letting your money sit in the saving account, enjoy very low interest rate, okay? Because I believe that interest rate eventually come down, right? So do something now, because at the present moment, the valuation is pretty attractive. You can lock in a cheap price, not cheap okay? Relatively at a cheap valuation with minimum to 5 to 6% dividend. That means those relative safe REIT, right? It's definitely can beat the inflation, definitely can beat your bank interest rate over the long term.
Right. So currently the S-REITs market here is undervalued, right? According to the data by SGX, the price to book, which you have also mentioned, is roughly about 0.8 times or 0.9 times in between.
0.8.
Yeah, around there. So therefore, this is a opportunity for investors to accumulate more positions, right, in Singapore REITs. But having said that, definitely we shouldn't just jump blindly into it. We should analyze the REITs further, like what we have talked about in this episode on some of the factors to look at to evaluate the financial performance, the operational performance before we are able to build up an entire portfolio of more sound and resilient REITs, right? All right, so it has been a really great discussion, interesting discussion that we have on this topic of REITs, and I hope that our audience, you had a great time tuning into this episode. So catch you again on the next episode of the FOMO Fix. Until next time, keep your FOMO in check, stay informed, and happy investing. If you're feeling fired up and ready to dive deeper, feel free to hit us up. Leave your comments below. We would love to hear your questions and topics that you would like us to cover in future episodes.